Too many people associate retirement with the end.
I figure it'll be a little bit of a transition to try to slow down a little bit.
The number one question I have about retirement is having enough money to last.
In my mind, you start to look at it, that's an opportunity to do more of the things you want when you want to do it.
Make it financially able to do things that I enjoy.
Party.
Just financial security and enjoy my family.
More people need to go into it with their eyes wide open, understanding what is my plan, what do I want to do, and then how am I going to get there?
Will the rules change?
I have no real specific plan.
I'm planning for what the status is right now. I just hope it doesn't change drastically.
Welcome to the RetireTastic Show with JoAnn Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona. In retirement, it's all about income. And today, you'll hear ideas, concepts, and strategies designed specifically to generate reliable retirement income. Now, here's the host of the RetireTastic Show, JoAnn Regan.
Today, we're going to highlight a topic that every one of us is familiar with. No matter what age group you're in, I guarantee that you're familiar with this, and it's called inflation. Now, you really have two choices with inflation. You have the choice of ignoring it and hoping that it'll go away, or adapting to it. And might I suggest that you adapt to it? It's very much like air. Whether you like it or not, you have to have it. It's all around us, and there's nothing we can do about it. So nice having you back with another edition of the RetireTastic Show. I'm JoAnn Regan, your host, and my goal is to help you have a fantastic retirement. So we're going to spend a little time talking about inflation. And specifically, we're going to talk about four things pertaining to inflation. One, what is the stated rate of inflation right now and over history? What is the real inflation rate? Is there a difference? And four things that you can do to protect yourself against it. And you think to yourself, why do I have to protect myself against it? Well, if you don't, you're going to run out of money before you run out of time. Why? Because inflation is going to eat it up. Think about the Cookie Monster and an unattended plate of homemade chocolate chip cookies.
Snack time!
I can't help it. I laugh every time I hear that. So as you all know, I'm somewhat of a numbers girl, so let's go through the numbers a little bit, shall we? And I'm going to give you some statistics. These are kind of shocking, but here you go. Couples that are 65 years of age have a 50% chance, that's 50% chance that you're going to live to 92. Well, that should make you feel good. Matter of fact, I had a doctor tell me, she said, if you make it to age 65 and you haven't had any major life-threatening illnesses, that you have a really good chance of making it into your 80s and 90s. So with that being said, if you make it to age 90, that's almost 30 years in retirement. So here you go. Couples need to plan for a 30-year retirement. So back in the 80s, things were different. And of course, you didn't really know they were different until you start comparing things now. And so this is something that I kind of looked up and found out that the average male back in the 80s only collected 13 Social Security checks. That's actually shocking and sad. That means that was not a very long retirement. But guess what? Today, we're looking at 25 to 30 years in retirement. Hooray for modern medicine, but it's actually one of the things that hurts you. The rising costs of medicine, medication, and hospitals, all of that hurts you in your retirement. So I'm going to give you a little, for instance, or another example, postage, because everybody mails things out. Did you know that in 1980, a postage stamp was 15 cents, and today a postage stamp is 55 cents? Price of stamps have tripled over that time frame, and I actually heard that in August, postage is going to go up again. So here's the issue. Someone that retires today may need as much as 2 to 3 times the amount of money at the end of retirement as they did the first day in retirement. Let me repeat that. Today, retirees need as much as 2 to 3 times of income and money at the end of the retirement that they did at the beginning. And we're not even factoring into things like healthcare costs, Alzheimer's, things like that can tilt the pinball machine right there. I need you to think about that when it comes to your income, your Social Security, your pension. You're planning on a certain amount of money that you're going to have a certain income by the time you're 65, but you really need to factor in that you're going to need more income when you get to the end of your retirement, sometimes 2 to 3 times more. I want you to hear what the senior VP at Bankrate.com recently had to say about our current situation when it comes to the government stimulus and inflation. Here's a short clip of Greg McBride from the Income Generation Show.
There are risk factors in play that could make this a more sustained increase. And I think the reality of it is inflation is probably, even once the dust settles, inflation is still going to be increasing at a rate higher than what we had grown accustomed to over the last decade. The last decade, inflation couldn't get above the 2% mark. I think over the coming 5 years or so, I think more in the 2.5% range is going to be the new normal we'll have to get used to. Once the dust settles on a lot of this stimulus, then what do we see? That's going to be more telling in terms of what the trend is going forward.
So there you have it. The senior VP at Bankrate.com talking about sustained higher inflation possibly being the new normal. Ouch. That really hurts. So the point I'm trying to make here is if you don't plan for having more money at the end of your retirement than you do at the beginning, you could have a plan that may fail. And I'm going to talk to you about how you can have a plan that will take care just about every scenario. Now, if that's something that concerns you and you find shocking and you didn't plan for, and you're saying to yourself, I planned on having enough money for age 65, but I didn't think about the fact that 80 or 85, I might need more. I have something that you might find helpful. It's a commission report titled The Universe of Non-Stock Market Income Generating Alternatives. Let me repeat that. It's a report titled The Universe of Non-Stock Market Income Generating Alternatives, and this will help you plan for this problem. So if you'd like to get a hold of that, give me a call at 1-800-FSG-7890. Again, 1-800-FSG-7890, and we'll make sure you get that report. So coming up after the break, we're going to be talking about the 4 most important things about inflation and how it affects your retirement.
This is the RetireTastic Show with JoAnn Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona.
Would you like to know how you can tell if an advisor specializes in individual income-producing instruments versus an advisor who uses a combination of stock market and growth-oriented vehicles? Because if they specialize in the latter, they're more likely to invest your retirement accounts into bond mutual funds rather than individual bonds and bond-like instruments. Why is this important? Because when an investor buys an individual bond, they're guaranteed a fixed rate of interest for the life of the bond. And when the bond matures, they're guaranteed their principal back, assuming there has been no defaults. With that assumption, an investor knows exactly what they're going to earn on the bond that they hold to maturity. Bond mutual funds don't pay a fixed rate of interest. As a matter of fact, the interest that they pay fluctuates. Also, bond mutual funds don't have a maturity date. They will go on forever or until you liquidate them. So bond mutual funds can be a lot riskier than individual bonds. Most people in or near retirement who have saved their hard-earned money over a longer period of time are better suited to invest in a portfolio of individual fixed income securities for the purposes of safety and steady income. If you would like to learn more about whether individual fixed income securities are right for you, give us a call.
To speak with JoAnn off the air, call 800-FSG-7890. That's 800-FSG-7890. Or visit us online at yourfsg.com. Welcome back to the RetireTastic Show with JoAnn Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona.
Thanks again for listening to the RetireTastic Show, and I'm JoAnn Regan, your host, and my goal is to help you have a fantastic retirement. And today we're talking about inflation. So if you're just tuning in, before I go any further, I want you to hear from Peter Schiff. He was recently a guest on the Income Generation Show, which did an entire hour on inflation. And here's what he had to say about helping the wealthy.
Well, inflation benefits debtors, with people who have borrowed money, particularly to buy productive assets, and it hurts wage earners, savers, people who have credit. Right. So that's going to happen. But remember, all of the stimulus, all of the bailouts have to be funded. They have to be paid by something. And if the government is not going to pay for it with taxes, they're doing it through inflation. The government is funding the stimulus and the bailout by stealing the purchasing power of savers and spending it into the economy. But again, there is no free lunch.
So are you the wealthy that Peter was talking about, or you're a wage earner? There's a big difference about how inflation impacts you. And what does that mean if you're very near or in retirement? You see, retirement is really kind of an interesting thing. It's not just a big phase of 30 years that you go through that's all fun and games. And as they call them, the golden years. How do I know this? The average age of my client is 72 years of age, but I also have clients that are 90 and I have clients that are in their mid-50s. A lot of different ages of clients, and this gives me an opportunity to learn a lot about aging. So one of the things that I've learned about retirement is that it comes in phases, and when you hear this, you're going to think I'm making fun, but I'm really not. It's funny because it's true. So these are the phases in retirement. Are you ready? The first phase, if you're fortunate enough to retire at age 60, and you start early into what I call the go-go years. Yep, the go-go years. That typically lasts until you're about age 75. Then from 75 up to 80 or 85, you are now in what I commonly refer to as your slow-go years. You still want to go, it just takes a little longer to get going. And you don't maybe want to go as far. That 13-hour flight to New Zealand from the coast is just not as entertaining as it was before. Then you go from about 85 on to the no-go years. Now, here's the thing you have to remember. What causes you to go from no-go to slow-go to no-go to go-go and all of the goes? Understand what makes up go-go. Your time, your health, and your money all have to line up. And the one thing that changes in all of that is usually your health. Health is the one thing that changes, and you can't help it. So basically, the point that I want to make here is that if you're invested in a lot of risky things and you're seeing your accounts lose 12, 13, 14, 20, 30, 40%, you're maybe 65, 70, 72, you're pulling out required minimum distributions, you need to take a hard look at what you're invested in. Because over the long haul, what you're invested in is going to make sure that you make it through your retirement and have money at the end and you don't run out of time. Now I'm going to give you another true stat, and you can Google this. You know what the number one fear of retirees now is in retirement? I'll tell you what it used to be. It used to be running out of money. Not anymore. The number one fear now is the rising cost of health care. And number two is running out of money. The goal of this show is to help you and honestly give you the information that you need to use it in your retirement planning. And one of the things that I want to give you is our commission report, Universe of Non-Stock Market Income Generating Alternatives. If that's something that you're interested, give me a call at 1-800-FSG-7890. Again, 1-800-FSG-7890. We're going to be talking about investments that can give you a true hedge against inflation. So if you're just tuning in, this is the RetireTastic Show, and I'm JoAnn Regan, your host, where my goal is to help you have a fantastic retirement. So what is the real inflation rate? Well, let's think about a retiree versus a younger person, someone in their 30s. Someone in their 30s, they're spending their money on their house, their cars, basically long-term loans that don't change. So in other words, maybe half of their money is going to cost food, medical costs, cost of fuel, and all of the things that inflate. How is that different for someone who's retired? Well, you know, the number one complaint I hear from retirees, especially in their 70s, is they have no tax write-offs and everything is paid for. So when you're spending money at age 70 on things that have nothing to do with fixed loans, inflation is definitely much higher. So let's talk about things that you can do to maybe get ahead of inflation. So I'm going to talk to you a little bit about how it works. So if inflation is at 3%, you have to get into something that's paying 5 or 6% to stay ahead of inflation. You can take that difference and reinvest it. And what things might those be? Well, that's what we've been talking about earlier in the commission report, the universe of non-stock market income generating alternatives. So I'm going to give you a few instances. There are still some really good corporate bonds out there. Now, that's interesting because you're going to hear me say that, and then you're going to go back to your advisor and say, hey, I was listening to this person on the radio talking about corporate bonds doing this, and he's going to say, oh, he's talking about high yield bonds, the ones that are risky, bonds that don't pay that. Let me tell you that if he says that, that's a sure sign he doesn't know how to go find them. Things such as preferred stocks, that again outpace inflation, there's a lot of things that can do that. We talk about these in the commission report entitled The Universe of Non-Stock Market Generating Alternatives. If you'd like to get that commission report, give me a call at 1-800-FSG-7890, and I'll make sure that I get that to you via email, mail, or whatever you need. Again, 1-800-FSG-7890. So let's talk briefly about things that don't stay ahead of inflation. One of the most popular things that people go to hedge against inflation is gold. Gold is pretty, but gold does not hedge against inflation. Matter of fact, it's one of the worst possible things you can do to hedge against inflation. Now, I'm going to go back and tell you that it did hedge against inflation when the dollar was tied to the gold standard, but it's been a very, very long time since the dollar has been tied to that. So what is a good hedge against inflation? Again, we talked about fixed income. Now, when you hear me say fixed income, you're going to find out, and again, I don't want to bash people on the radio, but you're going to find out that there's not a lot of good information about how to generate fixed income. I can tell you that nobody these days is talking about the universe of non-stock market income generating alternatives. This is basically what advisors did back in the 50s and 60s when they came out of stock market crash. The stock market crash, you want to talk about a generation of people that had a depression mentality. Let's talk about that group of people from 1955 and beyond. That group of people literally went through the stock market crash, and I have more admiration for the advisors that worked back in that era than the guys today, because they taught about taking interest only and don't touch the principal. Matter of fact, it was actually around that time that the rule of 100 was created. Do you know what that is? It's basically minus your age from 100, and that's the most you would ever have in the stock market. For example, let's say you're age 65, so 100 minus 65 is 35, so you should have no more than 35% of your money in the market. Now, fast forward to today's advisors, and do you know what the rule of 100 is usually stated as? It's stated in the lawsuit when the 80-year-old woman or male or family sues the advisor for putting them in an unsuitable investment. The advisor is being sued by an attorney that states the rule of 100 in the lawsuit, and everyone should know about that. When we come back, we're going to talk about how the financial services tries to protect you and what you should actually do to protect yourself from this inflationary problem.
The RetireTastic Show with JoAnn Regan airs Saturday afternoons at 1 and Sunday mornings at 8:30. You're listening to the RetireTastic Show with JoAnn Regan, powered by the Retirement Income Store. Have you missed any of today's program? No problem. You can hear all of the RetireTastic Show online anytime, 24/7 at yourfsg.com. That's YOURFSG.com. Remember the good old days when you could earn 5% on a bank CD? What if you could earn similar rates on interest and dividends to those CD rates? It's possible. And the income specialists at the Retirement Income Store can help you. We're a network of experienced financial advisors operating independently owned firms under the umbrella of the Retirement Income Store. This makes it simple and easy for you to find a retirement income specialist in your local area. Our advisors have helped hardworking Americans across the country invest and save for their retirement.
To learn more about the Retirement Income Store, call your local Retirement Income Specialist, JoAnn Regan of the Financial Security Group at 800-FSG-7890. That's 800-FSG-7890.
The Retirement Income Store, where retirees go for income. Time now for more of the RetireTastic Show with JoAnn Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona.
Inflation is an insidious thing, and if you don't think so, here's what the evil Darth from Star Wars thinks about it.
You will find that it is you who are mistaken about a great many things.
I have to say I completely agree with the evil Lord on this one. Inflation is the one thing that you don't see creeping up on you that could have a massive negative effect on your retirement. Thanks again for listening to the RetireTastic Show, and I'm JoAnn Regan, your host, where my goal is to help you have a fantastic retirement. And so if you're just now tuning in, we're talking today about inflation. And as we talked earlier in the show, the average retiree has a 30 to 35 year retirement. Stats show that you may need as much as 2 to 3 times the income at the end of your retirement as you needed at the beginning. So before the break, I mentioned that I was going to talk about what the industry tries to do to solve this problem and what you can actually do. As stated earlier, I said there are 4 things we're going to talk about pertaining to inflation. What is the stated inflation rate? What is the real inflation rate actually for retirees? Why is there a difference? Because the things that retirees spend their money on inflate, and the younger person spends their money on things that are fixed, more like cars and houses, things that don't inflate. Those loans don't go up and they stay steady for, say, like 30 years. So right now we've concluded that maybe the stock market and gold may not be the greatest hedges against inflation. It's one thing to hear me talk about it on the radio, but it's another thing to actually see it in front of you. So ask me for that commission report, The Universe of Non-Stock Market Income Generating Alternatives. If you give me a call at 1-800-FSG-7890, I'll make sure to get that to you. That's 1-800-FSG-7890. So there's another way that the industry tries to approach the inflationary problem. So if they don't put you in the stock market, then what are they going to put you in? You know, you can talk about fixed returns, maybe CDs or something with the bank or some kind of program that pays you a fixed return, which right now is pretty low, 1 to 3%. And then they may also be talking about some annuities, and some of those, especially good annuities, can pay you very well. And not all annuities are bad. Some of them do get a decent rate of return. But I will tell you and warn you that if you're being talked about a variable annuity that gives you a guaranteed growth on income 5 to 6% a year, let me tell you, run. Don't walk from that advisor. It's the single most expensive way to take risk in the stock market. Lots and lots of fees. We're talking about 3 to 4%. Another thing that the industry likes to talk about is bond funds. And I will tell you that there is a major difference between bond funds and actual bonds. A bond fund or a mutual fund that contains bonds is actually just 100% in the market. So that's not really diversifying yourself out at all. But let's talk about corporate bonds, because that's a little bit different. A corporate bond is where a corporation needs to go out and borrow money and they issue a bond. So when they borrow the money and issue the bond, they are going to offer it at a certain price. And let's say that when you purchase that bond, it's an interest rate, and maybe that interest rate is 5%, and it might have a maturity date of, say, 20 years from now. So in the example that I'm telling you, let's say you went out and bought this bond for $1,000, and they're paying 5% interest, so that means they're going to give you that 5% interest check every year. And understand that if the price of the bond goes up or the price of the bond goes down, it doesn't make any difference because you're still going to get that same interest check every year. The income stays the same. That's why we call it fixed income. It's fixed. And at maturity, if you hold it all the way to maturity, they're going to give you back the same amount that you paid. And that's what we call fixed income. So there are really only 2 ways you can make money. You can make it through growth, and that growth may be through the stock market, and you can do it through income, fixed income. And this is where I really want to stress that, you know, if you're going to have a stress-free retirement, you want to take income and not growth, because I will tell you that it's going to outpace inflation. So that's all I have for this week. I really appreciate you listening to me. Touch base with me at 1-800-FSG-7890. Again, 1-800-FSG-7890. I look forward to speaking with you off air and talking to you again next week. Have a great week.
That's all the time we have for today. To speak with JoAnn off the air, call 800-FSG-7890. And for more information about our program, visit yourfsg.com. The RetireTastic Show with JoAnn Regan airs Saturday afternoons at 1 and Sunday mornings at 8:30. To speak with JoAnn off the air, call 800-FSG-7890. That's 800-FSG-7890. Or visit us online at yourfsg.com.
Investment advisory services offered by FSG Financial Services, Inc., a registered investment advisory firm in the states of Arizona, Nevada, and California. Sound Income Strategies, LLC, an SEC-registered investment advisory firm, is a sub-advisor of FSG Financial Services, Inc. FSG Financial Services, Inc. and Sound Income Strategies, LLC are not associated entities. FSG is a franchisee of the Retirement Income Store. The Retirement Income Store and Sound Income Strategies, LLC are associated entities.